Hi everyone, welcome to the funniest course in the world, Accounting for Business Decision A. Today I will talk about one of accounting concept, receivables. By the way, receivables are also known as accounts receivable. Let's look at our first question. What is receivables? Accounts receivable refers to the short-term amount due from buyers to a seller who have purchased goods or service from the seller on credit. Accounts receivable is listed as current asset on the seller's balance sheet. For instance, if today is Monday and I do not have accounting for business decision today, so I feel bored and want to have something to give myself some energy, and I'll go to the 7-Eleven and order a cup of coffee by using my credit card. Though the 7-Eleven will receive the money within 24 hours, they still record this transaction as accounts receivable before they actually collect money, and they are classified as current asset. An uncollectible account is written off when the expense is recognized depends on the method of accounting for uncollectible accounts. Let's look at question 2. What are methods used for accounts for uncollectible receivables? Two methods to account for bad debt expense: direct write-off method and allowance method. Direct write-off method. Under the direct write-off method, bad debt expense is recorded when the business determines that a receivable is uncollectible and remove it from its records. While the method is required for most tax purposes and it's simple and it violates GAAP, the matching principle. Shortcomings of the direct write-off method are: it fails to match bad debt expense with revenue since it delays the expense until the account is determined to be uncollectible. It provides an opportunity to manipulate earnings each period by writing off accounts. It does not provide the best estimates of how accounts receivable affect expected cash inflow. The entry is recorded as follows. Remember, the debit always on the left and the credit always on the right. There are three basic methods of estimating bad debt expense. Aging of accounts receivable approach. This is a function of company receivable balance, while the allowance account adjusts to reflect the estimate of uncollectible from existing accounts. Advantage. It provides an estimate about the amount of uncollectible receivable by considering the likelihood of default accounts receivable by each outstanding date range. Disadvantage. It's not good matching. Percentage of sales approach. This is calculated by multiplying sales for the period by some percentage set by the company. Typically, this is between 1 or 2% of credit sales, but will vary from the volume of business. Advantage. It is simple and it is a good matching. Disadvantage. No consideration for the resulting balance in the allowance for bad debt expense. Percentage of accounts receivable approach. This is a function of company receivable balance, where the allowance account is adjusted to reflect the estimate of uncollectible from existing accounts. Advantage. This approach is better at estimating the true net realizable value of accounts receivable. Disadvantage. This approach is usually considered to be somewhat less precise in meeting the requirements of the matching principle. Accounts receivable also affects the future cash flow. The cash inflow from accounts receivable can be used to pay suppliers, maintain company daily operation, and even make an important investment. One more bad debt expense, the company will be in danger and is operating at the risk of liquidation. Thank you for watching this